You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, last week we talked about Home Depot. We looked at a diagonal spread in Home Depot, and it kind of played out all right. Home Depot actually was less volatile than it has been in previous earnings announcements since the pandemic has been announced. So if we look at what happened in Home Depot, we were doing a diagonal trade where we were selling the nearest term option contract last week on Wednesday. The markets were closed when we did Home Depot. It was at the underlying stock was at 281.58 at the time we were looking at the option quotes. We sold the August 14th expiration 285 call. We bought the August 21st expiration 287.50 call, which means if that was done in the same month, that would be considered a short spread or have a requirement from 285 to 287.50. You would have some risk. So our whole point of doing that strategy was that we wanted the near-term option contract to expire worthless and allow us to own a long call at a relatively cheap price going into earnings, which is always the case when you're looking at buying out of the money options, particularly around earnings. So implied volatilities were a little bit up. They were up on the near-term option contract and obviously up on the further out option contract that contained the earnings. We were able to do the entire trade for a net debit to the account of $2.90. But remember, we had additional risk. So we said that if Home Depot actually got up to our short strike, 285, before that first expiration, August 14th, that we would just want to get out of the trade. We'd want to make note of that level. We should be profitable on the trade. And what ended up happening is that Home Depot really did nothing going into that August 14th expiration. Actually, on August 14th, it closed at 280.55. So that means that we received 80 cents if you wrote it all the way to expiration, let it expire worthless, for selling that short-term option. And that allowed us to be in the longer-term option contract going into earnings at a much lower price. They announced earnings. The stock was kind of uneventful overall, but there were points and times where that underlying was profitable. The stock went up as high as 288 on that day and actually closed near its high, but it didn't really make a huge move overall on the underlying stock. And if you stayed in it for a couple of days, because you did have a couple of days left to go into the August 21st expiration date, if you stayed in it for a couple of more days afterwards, but it was an earnings play, you should have got out, the market ended up actually closing down. So on the day that they announced earnings, it was Tuesday in the morning. The underlying ran up and ran back down. The high for the day was 290.58 and the low was 283.04 and it closed at 285. But it actually ran up more on the Monday going into earnings. So the expirations worked out luckily on this trade if you were looking at it. And on Monday, the stock opened at 284.40. Went to 289.22 and closed at 288.24. So personally, after that option expired in the front month, that August 14th expiration, and it never did actually get to the 285 strike, I would have just closed this trade out on Monday. I wouldn't have taken the risk. If I would have had a fairly profitable trade, that option contract should have been trading for quite a really good dollar amount, considering it was in the money, still had the juice from the pending earnings report. That would have been my goal. Why would you ride this into earnings and have all the risk of earnings? But if you did, because we did talk about it as an earnings play, then you still did okay as long as you got out at the right point in time. If you rode it all the way to the close after earnings, you would have been profitable for half the day and not profitable for the rest of the half of the day. So interesting trade overall. The fact that front month expired worthless, that is really what our goal was, and that's why we were doing that strategy overall. So we still have some earnings. Dollar General is what I'm going to look at today. Dollar General is going to be announcing earnings next week. Now, we've done quite a few, I would say, fairly advanced trades, and I do think diagonal spreads overall are one of the most advanced trades that beginning or novice leading into intermediate traders can do because of the multi-months to expiration. You got to watch it closely and really understand how different expirations will move differently based off of their strikes and as time decays and as the underlying moves. So that was a great learning experience last week if you did paper trade that Home Depot trade, and that's what these are always meant on Options Playbook Radio. They're always meant to be paper trades. So this week, we're going to kind of slow it down a little bit, and we're just going to say, all right, Dollar General has been one of the winners, if you can use that word, since we've had the big downturn in March. Dollar General has done well to hold its own. It's actually higher than it was before the pandemic at this point in time. And it's made a little bit of a run up going into earnings. It just breached the 200 level. And we're taping Options Playbook Radio on the 19th of August. It is a Wednesday. The markets are closed once again. And we had Dollar General close at 200.13. It was up $2.15 on the day. So a decent move, 1% approximately. On a day that just is leading up into earnings. So let's see if they can keep that momentum. And what we're going to look at doing is called a long call spread. It's very simple in that we're just going to be buying an option contract and selling an option contract that has an expiration date after their earnings announcement. So our expiration date is going to be August 28th. They're supposed to announce earnings on the 27th. And we're going to really focus on time value. If I'm ever looking at doing a long spread around earnings, I want to pay a lot of attention to how much time premium I'm buying versus how much time premium I'm selling. And the fact that Dollar General is trading really close to $200 makes the math fairly simple here. And I think it's a good example that we can talk about and learn from here on Options Playbook Radio going into earnings overall. And basically our goal here is to try to understand how time premium works inside option contracts. So if I was looking at this call spread, and now you can do this with a put spread. I just flip the coin. Let's be bullish. Stock's running that way, so we'll just talk about a call spread. But these concepts apply if you were doing a long put spread also. We're going to take that August 28th expiration. We have a fairly expensive underlying, $200, and because of that, that's going to add some juice to the option contract and contracts overall and their prices. A more expensive underlying means more expensive option contracts in general, and it's just true. They're kind of priced like insurance products. If you're buying a car, it's going to be more expensive for you to buy insurance on a Bentley than it is on a Chevy Cavalier. So it's the same type of concept. The more expensive the underlying, the more expensive the options are. And then you throw in the fact that we have earnings, so that also jacks up the prices a little bit. Implied volatilities start to rise. So if I have that situation, a long call spread is an interesting way to approach this if you want to pick a direction going into earnings. And when I'm looking at that, where premiums are rich, I'm going to look at buying an in-the-money option contract as my long leg, and I'm going to look at selling an out-of-the-money option contract as my short leg. Now, a lot of times, if you're approximately equidistant, in theory, in the real world, things are a little bit different, but in theory, if you go 5 points in the money, you should have as much time premium on your option contract as if you went 5 points out of the money. So if I straddle the 200 level, I should have approximately a 50-50 bet going into earnings. And I know bet is not necessarily a good word, but we are truly speculating with this trade because it's all about earnings. And we're hoping for the bump up after earnings, and we have a very short expiration. So there's not much that we can do about it, but we can manage our risk before we get into the trade. So in our example here, we're going to use the August 28th expiration. Like I said, the stock's at $200.13, $200.13. And we're going to buy the 195 call, 5 points down, right? 5 points in the money for this call option. And at the same time, sell the 205 call, 5 points out of the money. Now, that means that we are doing a 10-point wide trade. So in theory, if this was a theoretical marketplace overall and everything was priced perfectly, a 10-point wide trade that's centered around where that underlying stock is at should be trading for $5. Now, in the real world, we have it a little bit in the money. We have the underlying at 20.13, so it's 13 cents a little bit to the upside, right? And that's going to reflect in the call price. But if we look at this entire trade, we see that going into earnings, if we do a 10-point wide spread, as equidistant as we can get in and out of the money, the net debit is going to be $5.40. Now, the markets aren't open, so the market's going to be a little bit wide, but the midpoint right now is $5.40. So that means we're doing a 10-point wide spread. We have $5.40 worth of risk, or $540 for every one-by-one spread that we do, plus commissions. You always got to add commissions in because that adds to your total risk. And to the upside, we have $4.60 worth of upside. Now, once again, commissions, you'd subtract the commissions from the upside potential. So by looking at approximately how much time premium we're buying on the call, and obviously if we look at the time premium or the price of the option contract that we're selling, and since it's out of the money, it's all time premium, we are going to concentrate on making this a 50-50 speculation trade, in that I have approximately the same amount of downside as I do upside. Now, the underlying stock is trading at 200.13, so it's a little bit in the money, so it's favoring the call a little bit, which is also making the total cost of the spread a little bit more than $5 here. So it'd be $5.40 based off of the midpoint trade. All right. So if I do this trade and I go into earnings, one of the things about a long call spread is that they have a tendency to max out closer to the expiration date. So by picking the nearest expiration, basically one day after they announce earnings, we are taking advantage of the fact that when you do a call spread, you're selling a call option that wants the market to go down, and you're buying a call option that wants the market to go up. So the only way that it can really max out is if the time premium comes out of that short option contract. And there's two ways that it can happen. It can happen if the implied volatilities come in after the earnings report, and that's usually common, and then also as time decays. So in this instance, We are buying an in-the-money call option that's trading for, we'll call it at the midpoint, $9.30. But we're selling that out of the money option contract and bringing in quite a bit of premium. We're bringing in almost $4 worth of premium by selling that out of the money option contract. So there's a lot of juice in that option. And as I said, the markets are closed right now, so they're a little bit wider than normal, but the spreads are. So if I look at that trade and I'm doing this, and I actually see that the underlying stock goes up because we have out until the 27th before they're going to announce earnings. If we do see it go up, and we have made a few dollars on this, I'd prefer to take the trade off as opposed to riding it all the way into earnings. And then also realize that this is a trade where I'm risking $540 to make $460. And if it lands somewhere in between that 10-point wide strike, well, I'm just going to close that trade and get out. It's going to be a one-day speculation trade. We're trying to manage our risk by paying attention to how much time premium we're paying relative to the time premium we're selling. And that's going to be it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.